Hello and welcome back to the TheGeordiePig Investor channel. Today's video is going to be a little different. Normally I have a series where I quickly review subscribers' portfolios and give some feedback on what I'd improve. But in this video I'm sharing a real life example of working one-to-one with a subscriber to help refine their investing portfolio. If you didn't know, I offer a paid consultation service where you can jump on a call and take a deep dive into your personal investments. And before I get into it, just for the purpose of this video to hide the subscriber's real identity, I'm going to call him Bob. Before my call with Bob, I sent him a few key questions to understand his risk tolerance, financial goals, and the bigger picture of his situation. That way, by the time we spoke, I had already spent a couple of hours carefully reviewing his entire portfolio and mapping out ideas to discuss. This allowed me to create a personalized action plan, not just random stock picks, but a full strategy to help him move closer to his long-term investing goals. In this video, I'm going to walk you through that process, how I analysed his situation, the portfolio I built, and the reasoning behind each move. And if you're watching this thinking, I'd love someone to do the same for me, I also offer these paid consultations for anyone serious about taking their investing to the next level. It's a chance to get real direction and a portfolio plan tailored to you. I'll leave my email in the description below if you want to become a serious investor. Here's a little bit of background on Bob. He's 60 years old and works part-time as a therapist in the UK, a job he genuinely loves and plans to continue for at least another 7 years. His goal is to retire around 67 and eventually move to Asia. He already spends lots of his winters there, and he loves the warmer climate and the lower cost of living over there. Right now, Bob has £3,000 invested, but he's already got an additional £70,000 ready to put to work. He also has £50,000 on top of this in an emergency fund, which is sitting in premium bonds, which gives him the confidence to invest the full £70,000 without worrying about unexpected expenses. So already we can see the strong position that Bob is in to have such a great amount of money in an emergency fund, so well done to him for that, and moving forward it's going to give him a lot more confidence and peace of mind to invest that full amount. Bob's aim is to build a diversified dividend portfolio with low to moderate risk, something that's going to be pretty hands-off that generates a steady stream of monthly dividend income. While he continues working, he plans to add £600 every month and reinvest all dividend payments to accelerate the compounding effect. What's his ultimate goal? It's to reach £1,000 per month in dividend income within that 7-year period before he retires, so then he can start drawing out that as income to support his lifestyle abroad. And this is the portfolio that I started with. Right away, you can see it's pretty scattered. There's no clear structure to the allocation sizes, and a couple of positions make up over 40% of the entire portfolio. It's clear there wasn't much of a strategy guiding these choices. This is exactly where I come in. Fortunately for Bob, he had only invested a small portion of his total funds so far, which meant it wouldn't be expensive or difficult to get things back on track. After discussing over email Bob's initial ideas, I found that he was attached to a couple of his positions that he wanted to keep a hold of, so I made sure to include those in the new, more balanced portfolio. After understanding his goals and factoring in both the initial lump sum he's ready to invest and the monthly contributions he plans to add, I had no doubt we could build a portfolio capable of hitting his targets. From there, I got to work designing an ideal, achievable portfolio tailored specifically to his situation. And here we have the portfolio. It's actually pretty cool to see that he's already slightly up, as he has made around about £1,300 since I built this for him around a month ago. And we can see that the portfolio currently sits at around a 5.5% dividend yield, which will pay him over £4,000 annually from those dividend payments. I felt that given his goals and the fact that he plans to use this income in just 7 years, it made more sense to prioritise companies with reliable dividend income and strong yields rather than focusing mainly on lower yielding stocks with higher dividend growth. That said, his portfolio still includes some stocks that offer both solid dividend growth and steady income, as you'll come to see. With Bob's portfolio, it was important to make full use of the ISA allowance to shelter as much income as possible. While it isn't possible to completely avoid dividend tax, maximising the ISA and placing the higher yielding investments inside it helps protect the bulk of those payouts. With that in mind, I chose to fill his ISA with two high-yielding monthly dividend ETFs, the JP Morgan Nasdaq Equity Premium ETF, stock ticker JEQP, and also the JP Morgan Global Equity Premium ETF, JEGP. These provide strong dividends that are going to be tax-efficient income through the ISA. I like having both of these picks in his portfolio because they work together to provide strong, reliable monthly income while diversifying where that income comes from. JEGP focuses on large, established global companies and uses covered calls to generate steady dividends with lower volatility. Meanwhile, JEQP targets the tech-heavy Nasdaq, giving you exposure to higher growth names, so that does mean there is potential for a high yield with this one, but there is also going to be slightly more volatility compared to JEGP. By holding both, you're not relying on just one part of the market. Your income is spread across defensive, value stocks in innovative growth companies. Both funds pay monthly and use option strategies to help manage risk, creating a balanced approach for consistent cash flow and long-term equity growth potential. And with the yields being in the higher side and receiving income every month, I felt keeping these within the ISA made the most sense. They make up around 25% of the overall portfolio. Next up, we have the biggest position in the portfolio, and that is the JP Morgan Global Growth and Income, stock ticker JGGI. He already had a small position in this one and wanted to keep it within the portfolio, but at a bigger size. Initially, I actually suggested to Bob that he included the S&P 500 in his portfolio, but he preferred heavier exposure to dividends while still participating in market growth. Given that JGGI has outperformed VUSA over the past decade, I feel very confident in his choice. It's a reliable fund with a strong track record and offers an attractive dividend yield at around 4%, making it a solid fit for his dividend-focused strategy. With that in mind, this position makes up roughly 30% of the overall portfolio, and it's worth highlighting that this fund has delivered a strong average 5-year dividend growth rate at over 11% per year and is on a growth streak at over 9 years. This one will also provide the largest annual dividend payout in the portfolio, closely followed by the two funds I mentioned earlier, with all three together combining to make over £2,500 in yearly income. Bob then mentioned that he wanted a mix of US and UK dividend-paying stocks with plans to keep his existing positions in UKW, Shell, Bunzl and Pepsi. Overall, I was pretty happy with these holdings that he suggested, as they all offer reliable, steady dividends along with some growth potential. For the US side, I structured this part of the portfolio around dividend kings and aristocrats. These are companies that have paid consistent dividends for at least either 25 years, which is an aristocrat, or 50 consecutive years, which would be a dividend king. From this group, I focused on the most reliable names with a balance of stability and growth. Bob already owned Pepsi, so I added AbbVie, Procter & Gamble, Johnson & Johnson, and Realty Income. While Bob also held Vici Properties, I felt Realty Income's exceptional consistency and monthly payouts made it a stronger fit for his goals. The main trade-off with these US picks is that they have a slightly lower yield compared to the overall target of 4.5% to 6%, with the exception of Realty Income, but I balanced this by leaning on UK dividend stocks, which generally start with a higher dividend yield, since the FTSE 100 has always historically paid more than the S&P 500 when it comes to dividend stocks. Bob already had a solid mix of UK stocks, so it was more about refining those positions and adding legal in general to strengthen the income side while keeping the dividends reliable and growing. And as we can see, the UK dividend stocks are doing their job, because the overall portfolio dividend income for the yearly basis is up around that 5.5%, with those UK stocks dragging it back up, as well as having those two JP Morgan reliable monthly payers. Overall, the portfolio consists of 10 individual holdings and 3 ETFs and funds, with the 3 ETFs making up around 55% of the overall portfolio, so that means that the 10 individual holdings make up around 45% of the overall portfolio, which I think is a great split for Bob. Given the quality and stability of the companies involved, Bob can take a hands-off approach to investing. While I always recommend keeping an eye on the company's financial reports within your portfolio to ensure their goals remain aligned with yours, the portfolio is largely self-sustaining, especially as it currently has a dividend yield that sits at 5.22%. So just to recap over how this portfolio is going to work, like I mentioned earlier, the two high-yielding JP Morgan funds are the two that are inside his ISA, so that has maxed out his £20,000 allowance, and then the remaining £53,000 is invested in his general investing account. So that means that the 10 stocks plus JGGI are set up in a pie with the right allocation sizes within the general investing account, so all Bob needs to do is simply invest that £600 per month into the pie to stay on track. The longer term plan is to gradually transfer the entire portfolio into the ISA over the next couple of years. This way, more of his investments will sit inside that tax-efficient ISA wrapper, ultimately protecting a greater share of his dividend income and capital gains from tax as the portfolio grows, which I look forward to revisiting with him closer to the time. So as you can see on Snowball Analytics, it shows Bob exactly how much he is expected to make this month. Not only does it show this month's, but you can look as far as 12 months into the future to see what your portfolio is likely to be paying out. So for next year, Bob can expect to earn around £350 per month in dividends, but this doesn't factor in the reinvested dividends he's going to put into his portfolio or the new capital he'll be adding each month. With those contributions, the income should be significantly higher by the end of 2026. Bob now has an account with Snowball Analytics, which is a great tool for tracking his portfolio, as it's going to show him exactly how much income he's receiving and can keep a running total of dividends earned, and even flags if companies cut its dividend. This means that if dividend growth starts to slow, he can quickly identify the source and make adjustments in the portfolio if needed. Snowball also provides long-term projections, helping him see when he's on track to reach his bigger income goals, which I'm going to walk through next. If you're wanting to become a more serious dividend investor, then having a dividend tracking app is a crucial part of your journey. So if you want to be more like Bob on that journey of financial freedom, then make sure you hit my link in the description down below so that you can get a free 2-week trial of Snowball Analytics and even get a tasty discount if you decide to sign up. Check it out. By going in the My Goal section, we can see exactly when Bob is projected to reach his ultimate target. His goal is to generate £12,000 of passive income within 7 years, and the projections show that if he continues investing £600 a month and has a dividend yield at 5.5% with that growth rate at 5.2%, then he is going to achieve this goal within those 7 years. So this was really exciting for Bob to see, because he's gone from having a portfolio of around £3,000 that was generating next to no dividend income on a monthly basis to now generating over £4,000 on a yearly basis, and he can see exactly how he's going to achieve that goal within the target 7-year period, which must be so motivating to know that if he continues doing what he's doing right now, that he will hit his target. So as we can see here, Bob is on target to achieving that life-changing milestone figure of £12,000 in dividend income on a yearly basis. And I personally have no doubt that in 7 years, Bob will be enjoying sipping on cocktails in the sunshine, celebrating the financial freedom he's worked so hard to achieve. And that's a wrap on today's breakdown of Bob's portfolio and plan. If you're interested in setting up a one-to-one consultation call to talk through your own investment strategy, drop me an email. You'll find it in the description box below. Thanks for watching, and if you found this video helpful, don't forget to like and subscribe for more investing content. Until next time, this is the Geordie Pig Investor, over and out.